Imagine a company that just grew its revenue by 32%.
Right.
And they boast this insane, basically software level gross margin of over 95%. And they're using AI to just drastically slash their operating costs. I mean, on paper, it sounds like an absolute Wall Street darling, you know?
Yeah. A business just firing on all cylinders.
Exactly. But in reality, the stock is sinking, regulators are closing in, and the people actually running the company are quietly rushing for the exits.
It's the absolute definition of a market paradox.
Yeah.
You have this pristine, almost unassailable, fundamental financial data.
The numbers are just great.
Right, but they're colliding head-on with a very dark, very cautious market reality.
So welcome to today's deep dive. It is mid-August 2026, and we are putting Robinhood under the microscope.
Yeah, we've got a lot to get through.
We really do. We have a massive stack of sources today. We're pulling from an evidence-led equity research report built on official SEC XBRL filings, Alpaca technical data, FinHub metrics.
Insider trading logs, too.
Yep, and a whole slew of recent financial news articles. Our mission for you today is to unpack this massive contradiction.
Right, because Robinhood just posted blowout earnings. Everything looks perfect on the balance sheet.
But the technical momentum is completely broken. So we're going to cut through the noise and figure out what is really driving the value and the hidden risks of this retail trading giant right now.
And I think the broader lesson here is really how the market evaluates the present versus the future. When a company generates incredible cash flow in the current quarter, but the broader market just aggressively shrugs, it tells you that major investors are looking entirely past today's success.
They're looking for the catch.
Exactly. They are scrutinizing the foundation of the business model itself. So we're going to connect the mechanics of their financial reality with market sentiment and, well, some very real macroeconomic headwinds.
Let's start with those hard numbers, though, because the second quarter of 2026, the period ending June 30th, produced a report card that should theoretically make a swell chart go vertical.
Yeah, you'd think so.
Depending on the exact data feed, Q2 revenue came in at $1.308 billion, or $1.31 billion. That is up a massive 32% year over year.
Wow.
Earnings per share beat estimates at 62 cents, and the momentum is clearly building.
It really is. I mean, the first half of 2026 saw $2.375 billion in revenue compared to $1.916 billion in the first half of 2025.
So that implies what, roughly 24% year-over-year growth for the half?
Yeah, basically. So this isn't just a one-off lucky quarter driven by a single event. It's an accelerating trend line.
Right.
But the top-line revenue isn't even the most staggering part. We really had to look at the margin profile. Based on trailing 12-month metrics, Robinhood is operating with a gross margin of 95.24%.
Okay, I have to pause on that number. 95% gross margin is almost unheard of outside of pure software-as-a-service monopolies.
Yeah, it's wild.
Like if you're selling physical goods, you have manufacturing costs, shipping, warehousing, but Robinhood is just pushing data, right?
That is the mechanical advantage of a digital brokerage. Once the platform architecture is actually built, the cost to onboard one additional user or process one additional trade is effectively zero.
It's all just scaling.
Exactly. Their cost of goods sold is incredibly low compared to the revenue they generate from transaction routing, crypto spreads, and interest earned on user cash.
Makes sense.
And because of that structural advantage, their net margin over the last 12 months is 42.01%. They are keeping nearly half of every single dollar that comes through the door as pure bottom-line profit.
That is insane, and management is actively trying to widen that gap even further. Looking at the forward guidance, they actually lowered their 2026 operating expense projections.
Did they?
Yeah, they dropped it to a range of $2.675 billion to $2.775 billion. And the reasons they cited were AI efficiency gains and strategic layoffs.
Oh, interesting.
So they are growing revenue by 32% while simultaneously shrinking their overhead costs through artificial intelligence.
I mean, it's essentially the holy grail for a tech-adjacent financial firm. But before we move off the fundamentals, there is a fascinating quirk in the data we pulled from the sources that, well, it highlights how careful you have to be with financial news.
Oh, right, the discrepancy.
Yeah. Algorithmic news summaries, like the ones from you.com, reported Robinhood's Q2 net income at $573 million. However, When we dig into the actual SEC XBRL filings, the net income is recorded at $561 million.
Now, a $12 million discrepancy isn't exactly a rounding error. Why are the news algorithms spitting out a completely different number than the official documents?
Well, it usually comes down to the mechanics of how information is distributed. News algorithms often scrape preliminary press releases or standard investor presentations the second they drop.
So they're just pulling the first thing they see.
Exactly. And those initial releases sometimes present adjusted figures, excluding certain non-operating expenses or restructuring costs, basically to make the quarter look a bit cleaner. But the SEC XBRL filings are different. XBRL stands for Extensible Business Reporting Language. Basically, this is the machine-readable, legally binding financial data that companies are forced to submit to the government.
Ah, okay. So it adheres strictly to GAAP generally accepted accounting principles.
Right. It's totally stripped of any PR spin.
So the SEC's structured figure of $561 million is the gold standard. It is the unvarnished legal reality.
Definitely.
That is a crucial tip for anyone parsing through headline numbers in the financial press. Always check the SEC receipts. But this brings us to the core contradiction.
Yeah.
We have massive growth, 95% gross margins, AI slashing costs, and a massive net income. But then we look at the technical reality on the stock chart, and it tells a completely different story.
Yeah, it does.
The stock closed at $95.56 on August 14th.
Right. And to understand why the market is punishing a company with such stellar fundamentals, we really have to look at the moving averages.
The technical.
Right. These are lines on a chart that smooth out daily price volatility to reveal the underlying trend. Currently, Robinhood is holding just barely above its short-term 20-day simple moving average, which sits at $94.87.
But the intermediate and long-term picture is where the pain is really obvious, right? The stock is currently sitting below its 50-day moving average of $99.09 and below its 200-day moving average of $97.26.
Exactly.
And it is down roughly 38% from its 52-week high of $153.86.
And those moving averages aren't just arbitrary lines drawn by chart enthusiasts. They are mechanical tripwires. Institutional trading algorithms and large fund managers use the 50-day and 200-day averages as literal programmed inputs.
So when it drops below.
Right, when a stock's current price falls and gets trapped below both of those lines, algorithms view it as a broken intermediate trend. This can trigger automated selling or at the very least prevent large institutional money from initiating new buy positions.
It creates a ceiling of resistance.
Precisely. It creates a ceiling.
Which perfectly illustrates the paradox here. If the financial numbers are undeniably spectacular, why is the trend broken? Wall Street is clearly discounting these amazing margins.
Hey, they are.
It's like looking in the rearview mirror of a sports car going 100 miles an hour. The earnings report tells us the road behind us was completely clear and beautiful.
Right.
But the stock price is dropping because Wall Street is looking out the windshield and they see a massive traffic jam ahead.
That is a great way to put it. And that traffic jam is Robinhood's core business model. The market knows that Robinhood's revenue engine is incredibly sensitive to the whims of retail traders.
Because it's all based on engagement?
Exactly. It's highly dependent on crypto volatility and continuous net deposits from everyday users.
Yeah.
If the crypto market enters a prolonged winter, or if everyday retail traders just stop depositing new funds because the broader economy gets tough.
Robinhood's massive revenue can just evaporate almost overnight.
Right. Wall Street refuses to pay a premium for what Robinhood did yesterday. They are heavily discounting the structural risk of tomorrow.
Which means Robinhood cannot just sit still and rely on people trading Bitcoin and meme stocks forever. Management clearly sees the same traffic jam out the windshield, and they are actively trying to build a new road.
They have to.
Yeah, they're attempting to evolve from a simple gamified retail app into a highly complex, diversified financial ecosystem.
We are witnessing a massive pivot. I mean, they are actively trying to build a new moat around the business by expanding into asset classes that were historically strictly reserved for institutional players and the ultra-wealthy.
Let's examine this new product pipeline because it is incredibly ambitious. The sources show they recently raised $225.5 million to launch Robinhood Ventures Fund 2, or RVI.
Right.
And the core pitch of this fund is to give retail investors, the everyday people using the app on their phones, direct access to early-stage Y Combinator startups.
Yeah, and they priced 8 million shares of this fund at $25, though it actually opened for trading slightly lower at $22.50.
Mechanically, this is a monumental shift for retail finance.
It really is. Venture capital involves funding companies that are just starting out. companies that often have little more than an idea and a pitch deck.
And historically, venture capital have been locked behind accredited investor laws, right?
Exactly. You legally had to prove you had a high net worth or a massive income just to get a seat at the table, because early-stage startups have an astronomically high failure rate.
You could lose everything.
Right. But Robinhood is utilizing regulatory structures to pool retail money and democratize access to that high-risk, high-reward asset class.
And it doesn't stop at venture capital. The research indicates they're also accelerating the debut of publicly traded closed-end funds. For the listener who might not be familiar, what exactly is the mechanism of a closed-end fund, and why is Robinhood pushing into them?
Think of a standard mutual fund. People put money in, the fund buys stocks, and if someone wants to cash out, the fund has to sell some of those stocks to pay them.
Okay, pretty straightforward.
A closed-end fund operates entirely differently. It raises money just once through an initial public offering. That creates a fixed pool of capital.
Okay.
The shares of that fund then trade on the open market, just like a stock. The huge advantage for the fund manager, in this case Robinhood's ecosystem, is that they don't have to worry about constantly liquidating assets if retail investors suddenly panic and want their cash back.
Because the underlying assets remain untouched.
Exactly. The underlying assets remain untouched while the fund's shares absorb the market volatility. It creates a much stickier, more permanent stream of management fees.
So they are locking in capital. And then there's the third major expansion pillar, mention markets or prediction markets.
Yeah, this is huge.
This seems to be the next frontier for retail speculation. Instead of buying a share in a company, you are essentially buying a contract that pays out based on a real-world outcome.
Right, like will a certain economic data point hit? Will a specific event happen? It is pure outcome-based trading.
And funding this aggressive, multi-pronged expansion requires a massive war chest. Robinhood has built an absolute fortress of liquidity to back these plays.
They really have.
As of the end of June, they're sitting on $5.362 billion in pure cash and cash equivalents. If you include restricted cash, that liquidity pool rockets up to $13.674 billion.
Wow.
Yeah. Their total assets are currently sitting at a staggering $56.55 billion. They definitely have the capital to fund this evolution.
Oh, absolutely.
But, I have a sort of velvet rope analogy in my head when I look at all this.
Okay, let's hear it.
It feels like Robinhood is lifting the velvet rope to the VIP section of finance. They're gesturing to the everyday retail trader and saying, come on in, look at these exclusive early-stage startup investments, check out these outcome-based prediction markets. But lifting the velvet rope invites a serious question. As you said, early-stage startup investing is notoriously risky. Most of them fail completely. Are they actually democratizing finance for the everyday person? Or are they just democratizing the ability to lose money in brand new, structurally complex ways?
That question cuts to the very heart of the regulatory dangers surrounding the stock right now.
Yeah.
I mean, the lifting the velvet rope is fantastic for user engagement and driving new deposits.
Sure.
But when you introduce retail investors to assets that are highly speculative, illiquid, and deeply complex, you inherently take on massive platform risk.
Because people get burned.
Exactly.
Yeah.
The moment retail traders start losing money in complex instruments they don't fully understand, the government gets involved. The very products Robinhood is using to build its future moat are exactly what is drawing the dark clouds of regulation.
Let's talk about those dark clouds, because the sources point to a massive regulatory overhang. An exclusive report from NPR details that the CFTC, the Commodity Futures Trading Commission, along with federal authorities, are actively probing these mentioned markets.
Yeah, this is a big deal.
This probe is happening amid a broader, highly publicized controversy involving the White House and a prediction market platform called Kalshi. Now, to be absolutely clear, based on the evidence packet, Robinhood is not directly named in this specific NPR report.
No, they're not named as a direct target of that specific probe, but in the stock market, proximity is often just as damaging as direct implication.
Right, guilt by association.
Basically, Robinhood is loudly and publicly expanding into prediction markets at the exact moment the federal government is launching probes into how the entire sector operates. The CFTC is scrutinizing the mechanics of outcome-based trading, how it's marketed, and who is actually allowed to participate.
And if the government decides to severely restrict or shut down prediction markets, Robinhood's shiny new growth engine stalls out before it even gets up to speed.
Precisely. The stock market fundamentally despises uncertainty. Regulatory uncertainty is the absolute worst variety because it's entirely out of the company's control.
Right. An algorithm can't predict what a federal commission is going to decide on a Tuesday afternoon.
No. It can. And that overhang creates a massive chilling effect on the stock price.
And that chilling effect might explain the most glaring, flashing red flag in this entire research packet: the insider sentiment. Listeners, whenever you want to gauge the true health of a company, you look at what the people inside the building are doing with their own personal money.
Oh, absolutely.
And right now, the people inside Robinhood are aggressively hitting the sell button. According to the FinHub Insider logs, there were 54 open market sale transactions. That's 54 distinct times an A-sider decided to liquidate their stock, totaling roughly 689,000 shares.
Wow.
Yeah. And in stark contrast, there were only 4 purchase transactions.
To quantify the severity of that imbalance, the sources use a metric called the Monthly Sentiment Proprietary Ratio, or MSPR. Right now, Robinhood's MSPR is sitting at -100.
Wait, really? -100?
Yes, that is the absolute maximum negative reading possible in the dataset. It means the internal momentum, the collective behavior of the people who know the company best is entirely skewed toward the exits.
But wait, let me play a devil's advocate here for a second. If I look closely at the raw math and the sources, those 4 purchases totaled 710,000 shares.
Right.
So the total volume of shares bought was actually slightly higher than the 689,000 shares sold. Furthermore, if I'm a Robinhood executive, a huge portion of my compensation is likely stock options. Aren't I supposed to sell eventually?
Well, yeah.
Maybe I want to buy a new house or simply diversify my portfolio so all my wealth isn't tied up in my employer. Why is a 54-to-4 transaction ratio a terrifying red flag for the company's health rather than just, standard routine corporate behavior?
That is a crucial distinction to make. It really comes down to the mechanics of breadth versus volume.
Okay.
Yes, structurally, 4 massive purchases brought up 710,000 shares.
Yeah.
That volume is high, but it's highly concentrated. That could easily be a couple of top-tier executives exercising massive, pre-planned options blocks that were scheduled months in advance.
Or a single large internal stakeholder making a concentrated bet.
Exactly. So the volume doesn't necessarily indicate widespread confidence.
I see.
But when you have 54 separate sale transactions spread across the insider base, that demonstrates incredible breadth.
It's everyone doing it.
Right. It shows that a wide variety of directors, officers, and key employees, the people who see the daily operations, who read the internal regulatory memos, and who track the real-time deposit metrics, are independently, actively choosing to take their money off the table.
So it's not just one guy buying a house.
No, standard diversification happens, yes. But a concentration of sellers at this scale, resulting in an MSPR of -100, is a major cautionary signal.
Right.
It strongly suggests a widespread systemic lack of internal confidence in the stock's ability to climb higher in the near term. They are looking at the regulatory probes and the shifting business model, and they're choosing liquidity.
Breadth versus volume. The fact that 54 different insiders independently decided to sell speaks volumes louder than 4 massive, likely scheduled buys. And it is not just the internal regulatory fears they are hedging against. They're also staring down a deeply concerning macroeconomic environment. Even Robinhood's own executives are sounding the alarm on the broader global economy.
Yeah, the macro picture is tough.
The sources highlight comments from their chief investment officer, Stephanie Guild. She warned that while the artificial intelligence boom could keep the broader stock market trending higher, a 10-year Treasury yield climbing above 5% could seriously threaten the entire equity rally.
The 10-year Treasury yield is essentially the baseline for the global cost of capital. It's what we call the risk-free rate.
Right.
When the yield on a safe government-backed bond pushes past 5%, the mechanics of investing change dramatically. If an investor can get a guaranteed 5% return from the U.S. government, they demand a significantly higher potential return to justify taking a risk on volatile tech stocks or unpredictable retail brokerages.
It just pulls liquidity directly out of the speculative markets.
Exactly. Money flows out of speculative growth assets and flows into safe government bonds. For a company like Robinhood, whose absolute lifeblood relies on everyday retail investors having disposable, cheap capital to speculate with on their platform?
A high-yield environment is incredibly toxic.
Very toxic. If borrowing costs are high and savings accounts are paying out 5%, retail traders are far less likely to dump their cash into highly volatile crypto assets or early-stage venture funds.
So we're looking at a company standing at a truly fascinating high-stakes crossroads. Let's distill all of this down. On one side of the ledger, you have a financial machine. Robinhood is generating $1.3 billion in quarterly revenue, growing at an accelerating 32% clip.
Yep.
They are successfully utilizing AI to compress their operating expenses, resulting in a staggering 95% gross margin and keeping 42 cents of every dollar as pure net income. They have billions in pure cash fortifying their balance sheet.
But on the other side of the ledger, you have the market reality. The technical charts show a deeply wounded stock, trapped under its 50-day and 200-day moving averages, which invites algorithmic selling pressure.
And the regulatory storm.
Right, a massive regulatory storm brewing over their newest, most important growth vectors like prediction markets. You have maximum negative sentiment from the insiders running the company, with 54 separate individuals heading for the exits.
And hovering above all of it is the threat of high treasury yields suffocating retail liquidity.
Exact.
For you, the listener, the immediate application of this deep dive is actionable. You need to watch those technical tripwires. Keep a very close eye on the $99.09 and $97.26 moving average levels.
Definitely.
If Robinhood can muster the momentum to break and hold above those lines, it signals that large institutional money believes the fundamental 32% growth story is finally stronger than the risks. But if the stock stays trapped below them, the market is telling you loud and clear that they are still pricing in the dark clouds.
And absolutely watch the CFTC probe into mentioned markets. That is the regulatory wildcard that could alter their entire trajectory.
We've spent this entire deep dive analyzing the immense risk to Robinhood's stock price as they pivot into venture capital and prediction markets. But there's a broader, frankly more disruptive philosophical angle to consider here, isn't there?
There really is. Think about what happens to the traditional venture capital industry when millions of retail traders can suddenly crowdfund their way into early-stage Silicon Valley startups.
It changes everything.
Yeah. If Robinhood's gamble actually works, we might not just be looking at the messy evolution of a single retail brokerage. We might be watching the complete chaotic disruption of how innovation gets funded in the first place.
Wow.
When the retail swarm replaces the elite Sandhill Road venture capitalists, the entire power dynamic of tech funding shifts overnight. The question is, when does democratizing access cross the line into amplifying systemic risk? And more importantly, is Wall Street already pricing in the inevitable regulatory crackdown on that shift?
That is a staggering thought to leave on. The implications go way beyond a single stock chart. It is a fundamental rewiring of the financial velvet rope.
It really is.
Thank you so much for joining us on this deep dive. Keep watching those technical resistance levels, keep an eagle eye on the breadth of those insider sales, and as always, keep questioning the mechanics behind the headline numbers. We will see you next time.